All right, then let's get back into East Africa. 2022 is an interesting year for a couple of reasons. It's the 10th year of operations of a fast-growing niche of the credit market here in Kenya. It's a niche populated by non-deposit-taking, digital-only lenders. Until late 2021, the sector was largely unregulated. Now, there were 49 such lenders in the country by the end of last year, but the market is a highly concentrated one. Between them, M-Shwari, which is run by NCBA Bank, one of the top three in the country, and KCB M-Pesa have 41% of the market. Now, FSD Kenya did estimate that the value of loans disbursed in 2018 by these sorts of entities was just over $1 billion, or an average of about $328 per borrower per year. And where's this money going? Well, 35% of those who borrow use this credit to meet daily household needs. Another 37%, however, plowed it into their businesses. Often, these were SMEs. Other studies have pointed to very interesting skews. A 2019 paper from FSD estimated that 80% of all digital loans used the year earlier were taken by just 24% of borrowers. Now, to be fair, the sector has been widely criticized for its lack of data privacy and the steep cost of credit. In some cases, you're looking at annualized rates of well over 200%. But a study last year by the Kenyan Competition Authority found that the cost of credit was only the fourth most important factor in the decision to borrow, with less than 30% of borrowers being fully aware of the fees that they were actually taking on. Some hours ago, I spoke to Dr. Adano Wario. He's the Director of Planning, Policy and Research at the Kenyan Competition Authority. And I started our conversation on that topic by exploring why the cost of credit is apparently not the main concern for users of these platforms.
You might be aware of the interest rates, the rate that they charge. And these are also on monthly basis. They are not normally annualized for you to see if a platform X charges 7.5 interest rates per month. Another one charges 9 per month. If you annualize, this makes huge difference between what banks normally charge and what platform charge. So I think there's a need to educate consumers around these differences in interest rates, whether it's on monthly basis or annualized rates. So there's big difference in terms of what consumers need to know and how this need to be taken up in terms of maybe standardizing reporting procedures.
And that brings me to my next question, because one of the other things that the study pointed out is that there's a sort of big gap that was created in the market when these digital lending platforms are cut off from the Credit Reference Bureau data system. And one of the things that you're saying in this study is that, look, we need a way of sharing information, not just between banks and these non-bank lending platforms, but also providing positive information so that individuals can actually get proper differential pricing for the facilities that they're going into the market for. Can we do that with the existing hardware, or do we need to create a third-party platform to essentially help make this process take place?
There are different rates and payment period. There are early payment, the delayed payment, and then there are defaults. There's no incentive for early payments to be given favorable rates by different platforms or even open banks. So that's one of the things that we thought will be a good incentive to start with. However, getting back to your question, it touches on the issue of different platforms, different institutions having different database, which they have accumulated over the years, and they're using this data to see consumer behavior out there in the market. So there's a need for this gap to be closed over time. And I think this touches on the issue of interoperability between different providers.
The country has about 49, at the last count that I saw, 49 different digital lending platforms, but the market is still very highly concentrated. And the entities that essentially have the largest market share, the ones that are most closely linked, at least as far as I can tell, to mobile money platforms. It's M-Shwari, KCB, Equity Easy, and Fuliza as well, which is essentially another Safaricom product. So in that sort of context, is it possible for actually for us as a market to develop a lot more competition, a lot more switching, given that level of concentration?
I think it's possible. What we have just said is the fact that our study was focusing largely on unregulated and regulated digital credit platform. And therefore, what we have seen is that for large lenders, there's those segments which are regulated. And therefore, naturally, what you expect is information will be out there in terms of their performance, in terms of their record and all that they do. But in the non-regulated segment, there wasn't that information because they were not regulated. Nobody knows. So it's come kind of a jungle where you need to find your way in the market. So I think that kind of concentration, once non-regulated segment will be brought on board, that will create more information to the consumers and also more players in the way that we can easily identify which player is there and also see which ones are offering which services and products.
There's something interesting that also came up in the study. This question of switching, because one of the things that you highlighted was that you have one user might actually have 3 or 4 or 5 different facilities active at the same time. And more often than not, we've taken money from lender Y to pay off lender Z and so on and so forth. Could you walk us through how that plays out in the market at the moment?
Basically, there are 2 ways in which that happens. One is the fact that borrowers can borrow and repay existing loan, which is just the traditional loan. Or borrowers are borrowing to pay default on the loan that they have taken with provider Y. So what happens is that in a given instance, because non-regulated digital credit market is not regulated, and therefore they are not in the credit bureau, it's easy. Once you default on one provider, you have no chance to borrow from the same provider next round. So what people do is that naturally they have defaulted, maybe based on their own circumstances. The business was not doing well, or it was borrowed for a consumptive purpose. Therefore, there's no revenue to repay the loan. What they have done, therefore, is to change and have different applications on their mobile handsets and use this to borrow from different platforms. And therefore, this allows them to borrow and become debt distressed. Therefore, this was happening in the light of what was the circumstance. And the circumstance, of course, was the fact that in part we are during the COVID period, where a number of Kenyans were laid off and people were unemployed and the terms were tough. Therefore, it forced people to borrow more in the light of consumptive purposes, maybe as opposed to business investment.